Hi, in this video I would like to introduce you to the price leading indicator of Stockware Pro called flatline indicator. What you're seeing here is a flatline indicator. It consists of three lines. The white line is the signal line, the brown line is the stop loss line, and the green line is the target line. These three lines together form the indicator. In this video, I would like to show you how to utilize these three signal lines together to enter and exit a trade. This video is done in a 1-minute format and with the day trading signal. First, let us look at the Franklin oscillator indicator, which is a momentum indicator, a trend indicator, but it is a price lagging indicator. What does it mean by price lagging indicator? When the Franklin oscillator hits a support or resistance, it turns around and it moves like a wave above and below the zero line. But to confirm that the Franklin oscillator has turned around, it first has to move a bit after the peak. So it takes a few bars to confirm that the Franklin oscillator or the indicator has turned around. So that is why it lags behind the price change. Nearly every indicator available that you know is a price lagging indicator. There are only a few price leading indicators, and what we have developed here is a price leading indicator. How it works, I will explain to you. First of all, this price leading indicator is called a flat line indicator because it creates a flat line when it feels there a change in trend. Here it is now giving a buy signal. The signal is appearing at the peak of the Franklin oscillator curve, but actually the signal appears only after the price has reached this stage. So the flat line starts developing before that, and once the signal appears, the target line goes up and the stop loss line goes down, because now it is a buy signal. What for the target line, first we have to look at the first target that is created immediately after the crossover, that is this peak, this level. After this peak, this level is achieved, it's here, we have to look at the next level that is created. So that is how we use the target level. The stop loss line is a trailing stop loss, so you could use it to set your trades, to exit the trades, and also create a new entry point for your trade. You can use these stop loss levels. In this case, today I was trading this particular stock. I started looking at this stock at around this point. I missed this one as I was not around. So I started looking from this point. So I thought, okay, it has reached a peak level because the previous resistance was around this point. So I was thinking it is now reaching a resistance level and it might be a suitable point to short this stock. To find that best level to short, I used the previous target level that was created, which was around this point. So I created a short at this level. So I entered the trade around here, I think. But the price didn't fall immediately. It continued to go sideways and then started to move up, and at that point I created this stop loss level. I didn't use this level which was closest to the price level. Instead, I used the level that is slightly above it, because often times the tail of the price bar, which is the low or the high, will come and touch the stop loss, and you might lose the trade. So I used this stop loss level, and after this small rise, it started to fall again. Here it created a flat line, but because the stop loss line was away and the target line was also away, this flat line could be ignored. You can note that whenever there is a change in trend, the stop loss line and the target line will come close to the price chart. So I was watching the first target level, which is this peak. So I was waiting for that level to reach that, the price to reach that level. Which happened around this point. And then once that level is reached, the next target level created was around this level, this point. Here the stop loss line, you can see, came very close to and even touched the price level, and it also created a flat line, which was a strong upturn indication. But because the price had come under serious downward pressure for a long time, I was not expecting it to go up. So I fixed my stop loss level at this point. After it reached the first target, I set up my stop loss level at this point and waited. Sure enough, the price started to move downwards and reached my target level. So by the time the price reached this level, I had set up the trade already to close and exit at this point. The stop loss at that level had came down and touched the price chart. And here we can see the signal line again creating a flat line. Here you can see the stop loss trying to stay away from the trying to move away from the price. Basically telling you to continue to hold if you have entered a buy trade, it is telling you to continue to hold this position. The price is expected to rise to this level, it was predicting, because that is the first peak it created after the crossover. And sure enough, the price started to rise again and did reach the target price level. So that is how this trade ended. So whenever you enter a trade, make sure that you have done the back testing. Go back in time by using this feature. Go back in time and create the stop loss, the target and the signal lines, and find out the limits, because those limits will be very useful later in trade.